Good afternoon. I would like to welcome colleagues, friends, and guests, most importantly, who came to AFME today, and also participants who are online following this event. And most importantly, I would like to welcome Vicky Saporta, who is going to be our guest speaker today, this afternoon, on the future of the Bank of England balance sheet, how the Bank of England intends to manage its transition towards a new system of supplying reserves. And there is a very catching title of the presentation, but I will not share that with you. I leave it to Vicky to follow. Since February 2024, Vicky Saporta is the Executive Director of the Markets Directorate at the Bank of England. Vicky has had a number of positions in prudential regulation, financial stability, and monetary policy in a career spanning 28 years at the Bank of England. Vicky was at the heart of the macroprudential and microprudential policy reforms undertaken by the bank after the global financial crisis. From 2016 to 2024, Vicky was Executive Director of the Prudential Policy Directorate, leading the bank's work on developing the future regulatory framework after the UK's exit from the European Union, the PRA's approach to its new secondary objective to facilitate competitiveness and growth, as well as the delivery of substantial policy packages, including Basel 3.1, Strong and Simple, and Solvency UK. Vicky has represented the bank on numerous international committees dealing with central banking and regulatory issues and has led a number of international working groups and task forces. Vicky was the chair of the executive committee of the International Association of Insurance Supervisors from 2015 to 2023 and represents the bank on the Basel Committee on Banking Supervision, where I had the honor to work with her for an extended period of time back in the teens. Vicky is also on the Financial Markets Infrastructure Committee, which governs supervision and policy of systemic financial market infrastructure in the UK. She is a member of the Management Board of the Cambridge Endowment for Research in Finance and a professor in practice of the Durham University Business School. Vicky has got a number of publications, holds a PhD in economics, and an MPhil in finance from the University of Cambridge. And she's a well-respected lecturer and speaker at different international events. It is a real honor for us to host Vicky today here, and we look forward to your speech. After which we will have some time for Q&A. I have some questions already looking at the speech itself, and also we will open the floor for questions in the audience, and we will also try to bring in online participants if we have time to have some further questions. So Vicky, thank you very much again for agreeing to this, and the floor is yours.
So good afternoon. Thank you very much, Adam, and to AFME for having me today to give actually my first speech in my new role as Executive Director of Markets at the bank. So the title of the speech is Let's Get Ready to Repo. Well, I'm actually not averse to whipping a crowd into a frenzy, but I don't want to do that today. You might know the American boxing announcer, Michael Buffer. I don't know if you know him. He has this trademark catchphrase, "Let's get ready to rumble." So that kind of whips crowds into a frenzy. So you might want to get into a frenzy. I'll suggest no, because we're talking about central banking, but and there's certainly not going to be any boxing. However, I have something very serious to say, and it's a call for us to work together to prepare for the normalization of the Bank of England's balance sheet in a world where the bank is no longer taking extraordinary monetary policy actions, and we supply most of our reserves by lending against collateral. The question of what our balance sheet might look like after the process of unwinding our extraordinary monetary policy operations is over, this is what we call the steady state, and the journey to it, the transition to this steady state, sits right at the heart of what central banks do. A few weeks ago, in his LSE lecture, our governor, Andrew Bailey, set out the critical role that central bank reserves play in the financial system and how that relates to our core objectives of implementing monetary policy and contributing to financial stability. As Andrew has shown, the size of the bank's balance sheet is largely determined by the size of reserves we supply. This gives rise to the question of what is the best operational framework for supplying these reserves and what is the optimal quantum of them in steady state. Andrew Bailey and my predecessor, Andrew Hauser, have set out previously why we judge that monetary policy implementation and financial stability objectives are best delivered by a framework where we meet the system's demand for reserves and no more. As I will argue in the main body of the speech, implementing such a demand-driven system implies the need for regular and flexible lending operations which can respond effectively to fluctuations in the demand for liquidity. We launched the short-term repo facility, STR, in 2022 as one critical component of such a framework. Its aim was to ensure interest rate control at the point the Monetary Policy Committee, the MPC, started the process of unwinding its asset purchases, and it's encouraging to see it being used as we intended it to be. But the STR is just one part of our operating framework. We need to have other operations ready to fulfill a steady state vision, and our sterling monetary framework counterparties, yourselves, need to be ready to use them. This is the subject of my speech today. To give you the three key takeaways and the single punchline up front. First, we welcome the increased use of the STR as a key mechanism in ensuring interest rate control as we normalize our balance sheet. To generate the reserves that will deliver on our vision of a demand-driven operating framework in steady state, we need to use other operations to complement the STR. Second, out of the two most obvious ways of doing so, asset purchases and lending, e.g. through longer-term repo facilities, we think there is a good case to do so through repo. The bank already has a facility in place that can play this role alongside the STR. It's called the Indexed Long-Term Repo Facility, ILTR, which supplies reserves in market-wide auctions for a 6-month period against a broad range of collateral. We are in the process of reviewing the calibration of the ILTR to ensure that it is effective and attractive enough to support potentially large provision of reserves. We will be engaged further with the market later in the year, including through a discussion paper that we will publish. Third, the transition from where we are now with surplus reserves to a demand-driven framework is well underway. While we are still well above estimates or where the preferred minimum range for reserves demand may be, there is uncertainty about the accuracy of these estimates. It's important, therefore, that our facilities are robust to this uncertainty and that firms step up their preparations to ensure they are ready to use them sooner rather than later. The point at which banks will be required to borrow reserves to satisfy their payments and precautionary demand is firmly in sight. As part of this, and as I have already said, the recent increase in the usage of STR demonstrates welcome willingness and operational readiness to use our facilities. Indeed, for the same reasons, we also expect and would welcome increased usage of the ILTR as we move further into the transition to steady state. The single punchline is that both we, the bank, and you, the market, need to prepare ourselves for increased usage of both our short-term and long-term repo operations. Or in short, let's get ready to repo. Before we get to the core of the speech, let us recap some basics about operational frameworks. Implementing the desired monetary policy of policymakers to achieve the inflation target is a core aim of central banks like ours. Contributing to financial stability is the Bank of England's other core aim. But what do we precisely mean by a demand-driven system? Let us first recall the classic motives for reserve demand. 1, transactions to meet known outflows, such as payments. 2, precautionary to meet potential outflows in a stress, some of which follows from risk appetite influenced by prudential regulation. And 3, relative return on reserves relative to other liquid assets. In so-called supply-driven operating frameworks, the supply of reserves by the central bank exceeds the minimum level of aggregate demand of market participants at the prevailing policy rate. These frameworks are also referred to as conditions of abundant reserves and are illustrated in the right-hand side of this figure. The bank has been operating with abundant reserves since the quantitative easing programs and lending schemes expanded reserve supply above aggregate demand. That is for a very long time now. Under such a framework, banks' payments and precautionary demand is satiated, and marginal changes in demand are determined by the relative return motive. In that situation, if reserves had a relatively lower rate of return than other assets, banks would individually try to economize on their reserve balances by lending them out to those more willing to hold them, and that would drive short-term interest rate downwards. To avoid that, central banks operating such supply-driven frameworks maintain interest rate control by remunerating deposits at the policy rate, and that's what we do too. Now, as a balance sheet normalizes and we shift from the right-hand side of the figure towards the left, there will come a point where supply reduces to the level consistent with the aggregate demand for transactional and precautionary balances. We do not know where this point is, but for planning purposes, we have a range of estimates of where it may lie, which we call the preferred minimum reserve range, the so-called PMRR, which you can see here with the depicted by the shaded grey area. Were we to move further to the left of the PMRR, we would be in conditions of reserve scarcity. Under such conditions, banks would try to borrow reserves in the market, driving short-term market rates upwards, and we would not maintain interest rate control, all else equal. This is the reason the bank introduced the SDR at the point that the MPC started unwinding its asset purchases to avoid the situation. In a demand-driven framework, we aim to ensure banks can obtain enough reserves at or just above the point of incipient reserve scarcity, the point that the demand curve begins to be upward sloping. We expect market interest rates to be relatively stable around bank rate in this region, achieving interest rate control, which is a key and common objective of central bank operating frameworks. The net terms of our lending facilities will also influence the quantity demanded and will impact on the degree of volatility around bank rate. In other words, quantity demanded in a demand-driven framework is endogenous to the terms with which we supplied. We also expect the demand-driven framework to deliver financial stability benefits, largely because it is designed to supply the reserves that banks demand for payments and precautionary purposes. Precautionary demand is in turn influenced by regulatory liquidity requirements on high-quality liquid assets, so-called HQLA, that depend on the size and flightiness of banks, commercial banks' liabilities. By comparison to the demand-driven system I have described, a scarce reserves framework would encourage banks to rely more on non-reserves HQLA to meet banks' liquidity needs on things like gilts. Such assets are, of course, highly liquid, as the definition implies, but in order to be used to meet cash outflows would still need to be converted into reserves. As a result, such a framework would place greater reliance on the ability to immediately and smoothly convert non-reserves HQLA into reserves in a stress. At the same time, such frameworks may promote more private money market activity and liquidity recycling, potentially supporting the depth of repo markets and the ability of banks to convert non-reserves HQLA into cash. By the same token, the footprint of the central bank tends to be lower in scarce reserves frameworks, with associated reputational, financial, and political economy benefits. On the other hand, if markets are not used to banks accessing lending facilities in normal times from us, central bank operations may get stigmatized during market stress, which is not good for financial stability. As a second reference point, abandoned reserves frameworks, the other opposite to scarce reserves frameworks, abandoned reserves frameworks could encourage firms to rely too much on reserves to meet their HQLA needs and hold only limited amounts of other non-reserves HQLA. If in addition these reserves were provided through lending operations, encumbering assets that could otherwise be used to raise liquidity in a stress, reducing so-called dry powder, unencumbered assets, this could reduce the overall liquidity resilience of the banking sector, which is bad for financial stability. Given the trade-off involved between the financial stability costs of potentially stigmatized facilities associated with scarce reserve systems and the potential financial stability costs of less dry powder that could be associated with abandoned reserve systems, a demand-driven system seems to strike the right financial stability balance to hit some sort of sweet spot. Now, having argued that a demand-driven framework achieves interest rate control and best aids financial stability, the next question is how to assess the demand for reserves. In practice, we regularly survey banks on the preferred minimum level of reserves holdings and the factors that drive it. We cross-check this with estimates of the level of the PMRR derived from models and by using information from banks' prudential liquidity returns. Critically, any estimate is uncertain and will change over time. For example, if the world became structurally a riskier place, we would expect precautionary demand for reserves to go up. That is why our framework is explicitly designed to be robust to that uncertainty, to stand ready to provide reserves, whatever the true revealed demand turns out to be, higher or lower than our estimates. Now, that implies that we must have a set of flexible and usable facilities to meet reserves demand as it rises. Given that on all our measures, we expect a high level of reserves demand through repo than prior to the GFC, to the global financial crisis, those flexible supply arrangements must be able to do two things. First, supply a potentially large stock of reserves in the event that the revealed demand for reserves turns out to be large. And two, be responsive to higher frequency changes in the demand for reserves, both to maintain interest rate control as conditions evolve, but also responding to meet demand in stress. The latter, the second motive, the one about high frequency changes, implies the need to supply at least some reserves elastically via repo, so that changes in demand are broadly matched by changes in supply, rather than by causing fluctuations in market interest rates. This is the primary purpose of the short-term repo, the SDR, in that once a week, the supply of reserves is perfectly elastic. Banks can get as many reserves as they want for a short tenor of 1 week against high-quality collateral, gilts, at bank rate. Banks retain incentives to manage their liquidity over short horizons, as they can borrow reserves each day through private markets, and they can also make use of our operational standing facilities and the discount window, which are there to be used, albeit those are priced at the spread to bank rate, unlike the SDR. But how to best deliver the former requirement of our supply arrangements, how to supply the stock, is more of an open question. So now let me explore that in more detail, focusing on the steady state balance sheet. I will come to the transitional issues later in the speech. So we need a way of supplying the stock of reserves. So what way? At the simplest level, there are two choices for the bank in deciding how to supply the stock. We can supply a large portion of reserves by purchasing assets directly, which forcibly injects a fixed quantity of reserves into the system until those purchases are unwound. In our case, the most natural asset to purchase would be UK government bonds, that is, gilts. Alternatively, we could supply a large proportion of reserves by offering lending facilities, e.g. repo. As I have explained, the demand-driven nature of the operating framework we want to implement already certainly implies some role for short-term lending operations to supply the marginal reserve. But here the question is how much of the stock of reserves should be supplied by asset purchases versus repo. In his LSE speech, Andrew already gave you the headline. That is that we think there is a strong case against a set of principles for a majority of reserves to be supplied by repo operations in future. In coming to that view, we have assessed how a repo-led and a gilt-led framework would perform against a set of principles. There are several strong reasons to favor a repo-led framework from the perspective of our core policy objectives. First, a repo-led framework will allow the bank's balance sheet to shrink or grow in response to the changing level of reserve demand in the system, as well from individual firms. The result is likely to be both a more efficient and responsive Bank of England balance sheet and a more variable one, in which changes in the size of a balance sheet from one period to another come to be expected by the market. Moreover, a repo-led framework for reserve supply normalizes the use of bank lending facilities, which brings financial stability benefits. Firms are more likely to borrow from the bank in scale during periods of stress if they are ready to do so in normal market conditions. And by operating one which accepts a broad range of collateral, we ensure the largest possible number of firms can access our facilities. By contrast, supplying the majority of reserves through gilt purchases is likely to reduce the scale and breadth of participation in Bank of England facilities and risks also producing periods of excess reserve supply, since the central bank needs to decide and assess the size of the portfolio and might not get it right. Second, a repo-led portfolio will leave monetary policy makers with more room to maneuver. Providing the majority of reserves via repo would preserve the potential headroom for any future QE programs relative to a gilt portfolio. Reserve supply via repo can easily be displaced by QE operations when monetary conditions require such a stimulus, whilst keeping the risk of possible market distortions from the central bank purchasing a significant fraction of gilts lower. Third, a majority gilt approach in normal times would expose the bank and the public sector at large to greater interest rate risk, whilst not providing greater monetary and financial stability benefits. Andrew Bailey's LSE speech covered this area fully, so there's no need for me to elaborate further. So, although we believe the policy case for moving towards a repo-led framework is strong, there are also a number of challenges that we and firms will need to navigate. First, by tying up collateral for use in our reserve supply operations, a repo-led framework may result in the banking sector having less dry powder in the form of unencumbered assets to use in a market stress, relative to a gilt-led system. Our analysis to date suggests that the repo-driven framework would only result in a modest rise in overall encumbrance levels, although aggregates may conceal pockets of encumbrance within the system. Critically, the UK banking system has a large amount of potentially eligible collateral that is shown in the chart. By way of illustration, we estimate the potentially eligible universe of sterling loan collateral that exists today to be around 3 times the amount that would be needed to generate estimates of the PMRR, the preferred minimum range of reserves. So you can see 1.2 trillion sterling denominated eligible loans in the middle there. But currently, only around a third of that potential eligible loan collateral is pre-positioned with us to use if needed. So you can see that in the left-hand side. That highlights the need for us to collectively work on further pre-positioning. And the chart, I think, shows just the chart, this chart that shows how much more there is there to preposition, only shows the sterling denominated loan collateral, which is a subset of the level C collateral we accept. We accept a much broader range than that, levels A, B, and non-sterling C as well. So common preposition is the message. Second, another challenge is with a repo-led portfolio is that it will be a major change in operating practice, both for us and for the firms. The bank has not supplied a large stock of reserves via a repo portfolio for an extended period of time. That's what I will turn to now. In order to supply the potentially large stock of reserves that the system may demand in steady state, judging from our current survey-based PMRR estimates, something around 345 to 490 billion pounds, we need to complement the STR facility with a longer-term facility. Why is that? Even at the bottom end of this range, it would not make operational sense either for us or for our counterparties to keep rolling over such large amounts in using solely short-term facilities repeatedly. These longer-term lending facilities also need to be collateralized with a broader range of assets, making them usable for the widest range of firm business models admitted into our sterling monetary framework. This will aid the distribution of reserves where they are needed. And by accepting non-HQLA collateral in return for reserves, suitably valued and risk managed, a longer-term facility against broad collateral offers a way for the banking sector to adjust its aggregate holdings of HQLA as it deems necessary, since a liquidity upgrade against non-HQLA collateral adds to the supply of liquid assets in the financial system, which is beneficial for financial stability. We already have such a facility. The ILTR facility provides liquidity in the form of central bank reserves for a term of 6 months against the full range of eligible collateral, from the most liquid level A, such as gilt or treasuries, to the least liquid level C, such as loans. It is designed to be flexible and responsive to evolving market conditions by providing more liquidity to the market as demand for liquidity increases. Now, we have the LTR, and the LTR has been used by the market in size before, as you can see in this chart. It's the purple line. But unsurprisingly, usage has only been moderate in recent years. With ample liquidity in the system, including the presence of cheap term funding in the form of the COVID-era term funding schemes with additional incentives for SMEs, so-called TFSME, there has been less of a role for the ILTR. That means the ILTR has mainly been associated recently with provided liquidity insurance, which is why most of the use we've seen in the past has been during periods of stress, as you can see again in the most recent rises of the purple line. Now, as we transition to a repo-led, demand-driven framework, we expect firms to use the ILTR in normal times to source reserves for payments and precautionary reasons. Critically, we do not view it as a facility to be used solely for liquidity insurance purposes. Using a phrase deployed by Mark Carney when he was governor at the bank, we are open for business, and firms should use our repo facilities, both short and long-term, to source reserves in the future. And as I have explained, this means that unlike in a system of supply-driven abandoned reserves, moving forward, the ILTR plays a greater role in both supplying the reserves necessary for interest rate control, as well as supporting financial stability. We are therefore also in the process of reviewing the calibration of the ILTR to ensure it is effective and attractive enough so that it is used in business as usual, consistent with our policy objectives. By the end of this year, we plan to further step up our dialogue with market participants, you and other market participants, around how our facilities are calibrated, should evolve over time, and how markets will adapt to a changing liquidity environment, including through publishing a discussion paper where we will be asking firms' views on calibration, amongst other issues. We will also be doing sessions with firms next year to explain how our facilities work and what firms need to do to be ready to use them. As I have already alluded, we are not starting from a blank slate. Our current assets and liabilities reflect multiple crisis-era interventions, and by far the dominant driver of reserves has been unconventional monetary policy. The lion's share of that reflected funding for the MPC's QE program via reserves created to finance the asset purchase facility. And you can see that in that mustardy yellow depicting the biggest chunk of a balance sheet. In addition, COVID stimulus, such as the TFSME, added further stock of reserves into the system. You can see that through the sort of purple area. TFSME aimed to support the pass-through of low interest rates and support lending to the real economy through COVID-related disruption, and its unwind represents a normalization of the bank's balance sheet from such crisis-era funding schemes, on which the bank actually has had several. You can read all about them in the paper. As reserves fall as a result of QT and TFSME unwind, money markets are moving from years of plentiful reserves and relative collateral scarcity to the present period of falling, though still ample reserve supply, and more available collateral, including as government debt issuance continue. We are beginning actually to see this transition away from a supply-driven framework towards a demand-driven framework that I talked about earlier. We are moving from the right-hand side of Figure 1 towards the PMRR. As that process continues, banks' preferred holdings of reserves, as well as non-reserves at HQLA, will evolve, depending, amongst other things, on asset availability, relative rates of risk and return, and regulatory rules, as well as perceived ease of monetization and stress. And you can see that in Chart 4, that the proportion of non-reserves HQLA in banks' HQLA buffers has increased materially between December 2022 and last month. So this shows is just some evidence that the transition is happening. As we are moving towards, therefore, the PMRR that I showed you in that shaded grey area in Figure 1, and before we reach it, we expect frictions in the distribution of reserves to lead to pockets of reserve demand appearing, which could lead to periods of market rates moving upwards. Factors such as the return on reserves relative to other forms of HQLA could push up or down on the demand for sterling reserves, perhaps even above the PMRR, even for extended periods of time, and that may be reflected by usage of our facilities. That makes it possible that reserves could settle for periods above the PMRR, and correspondingly, we will expect firms to come to our repo facilities, either the SDR or the ALTR, or both, to source reserves. Indeed, we think we have been seeing some of these frictions, albeit in a temporary form, recently. Money market rates have been slightly more likely than in the recent period of especially abandoned reserves and correspondingly stable rates, to move upwards in response to demand for cash, especially around month and quarter ends when bank balance sheets are most constrained. We had an example of this at the end of April, when a large gilt maturity and a related fall in reserves coincided with global factors, increasing the relative demand for sterling through FX swaps. Repo rates rose to around 10 basis points above bank rate. You can see that around April. And SDR usage increased shortly thereafter, as intended in periods like these. We saw a moderation in the level of market interest rates thereafter as the temporary factors unwound. Turning to unsecured markets, in recent years, when reserves have been abandoned, the overnight unsecured rate, so-called SONIA, you see it in orange, has sat beneath bank rate. As the reserves have been falling, we have seen an increase in SONIA rate and the SONIA to bank rate wedge compressing, with the spread compressing by 1 basis point from around 6 in the first quarter of 2024 and being a stay to 5 basis points. Has been 5 basis points since. Reflecting this change in market dynamics, it is likely that market rates will be a little bit higher on average relative to bank rate than they have been over recent years. As a one-off transition that can be observed in real time, asset prices by the MPC, this is unlikely to be of any material significance to the setting of monetary policy. As the market adjusts to a structurally lower level of reserves, repo rates will likely become more volatile than we have observed in recent years. We will see them be more sensitive to changes in the balance of demand and supply of cash and collateral. As more firms become prepared to use our facilities to generate reserves, this friction should ease. Although there may be some limits to arbitrage from regulatory and accounting rules, we expect that over time, money markets may become more adept at recycling a lower quantity of aggregate reserves as the incentives to engage in such activity increase, which should contain the impact of these transitional bumps. The SDR has continued to be used over the period, with usage increasing in recent operations. One reason is that banks tend to roll their SDR drawings. Our market intelligence conversations with banks and other market participants are clear that the willingness of banks to do so does not mean that we are at or near the PMRR, but rather that the SDR is increasingly viewed as business as usual part of banks' liquidity management and funding diversification, even in conditions of abandoned reserves, which we still have. This broadening and normalization of SDR usage across our counterparties helps smooth the transition to both a more settled level of demand of reserves and towards a repo-lent Bank of England asset portfolio, which, as I have said, will also involve increasing usage of the ILTR. This all begs the often asked question: when will we arrive at the PMRR? The takeaway here is that we could, in some scenarios, be there relatively soon. I should, of course, remind that we explicitly don't need to rely on being able to estimate it with a degree of precision. This estimate is uncertain and depends on many things, some of which will evolve over time. The repo-led demand-driven nature of the framework is designed to account for that and to be robust to this uncertainty. That said, it is relevant for us collectively to have estimates of the PMRR as a planning assumption for getting ready to generate the majority of reserves through borrowing from us, the central bank. In aggregate, QT and the continued unwind of TFSME will further reduce reserves towards the PMRR. The pace of QT, which next will be decided by the MPC in its annual QT review in September, will be important determinant of that. With most TFSME drawings set to mature by 2025, we ask that firms continue to actively consider the plans for the repayment of TFSME funding and refinancing using other sources when necessary. Indeed, many firms are actively considering the repayment profiles of TFSME, and some have already made early repayments ahead of contractual maturities. You can see all that in this chart. Some firms have also indicated plans to use the ILTR as they refinance TFSME, which is welcome. As TFSME matures, will result in a release of collateral previously encumbered. Firms will need to balance any desire to use the collateral released by the repayment of TFSME to raise secured funding in private markets against the preparedness to access bank facilities, including the LTR, which, as mentioned, is envisioned to play a substantial role in supplying reserves going forward. Either way, firms should continue maintaining and building an appropriate amount of pre-positioned collateral at the bank to access all our liquidity facilities as needed, both in normal times and in stress. And as I have said earlier, there's plenty of more collateral out there that could be pre-positioned. To sum all of these factors up, Chart 9 sets out the path for reserves, as well as our survey-based estimate of the demand for reserves, taking into account different assumed paths for QE and TFSME unwind. Given our estimates of the PMRR, which, as I said, the last survey was 345 to 490 billion, we do expect reserves to settle to a relatively more stable level over the next few years, and perhaps as soon as 2025. At that point, we will have entered a second part of the transition towards a majority repo framework. One where the overall level of reserves is more stable, but the composition of assets backing those reserves continues to evolve. What we do need is to ensure the system and participants are ready to generate reserves to meet the PMRR using both our short-term and long-term repo facilities. Now, this is my last chart, and it illustrates in a stylized form how usage of our facilities could evolve as we transition towards a majority repo portfolio. You can see from the chart that as well as growing use of the SDR, we also expect to see growing use of the ILTR against the broad range of collateral, with usage becoming larger as TFSME gets repaid and QT continues further. Given the increasing role that the bank's facilities will play in the transition, banks will need to be operationally ready and have considered the plans for using our facilities as part of the normal liquidity management. If a member of the audience is a bank counterparty, a SMF participant in the jargon, without access to the ILTR and STR, then speak to us as soon as possible about getting access. Some firms currently don't have access and should be thinking actively about getting that plumbing sorted. And if your firm does have access to the ALTR and SDR, then it will be important to have ensured you have been through the relevant testing, and then by using the facilities, considered your collateral prepositioning, and that you have considered how our facilities can play a key role in your day-to-day liquidity management. All in all, we envisage a much bigger role for repo. On our part, we will ensure that our operations are ready to provide that stock across the ILTR and STR, and that we engage with you fully. On the part of firms, I ask that you ensure you are signed up, operationally ready, and have positioned sufficient collateral to use in both business as usual and in stress. So let's get ready to repo. Thank you.
Thank you, Vicky. This was really interesting. I think your calls to the industry were very clear, very clearly articulated. I will start with two questions, if you don't mind, if you allow me, and then we will open the floor to questions from the audience. The first one is a rather sensitive one. Lately, discussions surrounding QE or supply-driven provision of reserves by the bank and its fiscal implications has brought the bank's balance sheet perhaps to an unusual level of attention. How does the approach, i.e. the transition to a demand-driven provision of reserves by the Bank of England and your approach today align with these discussions or sit alongside with these discussions on QE and its fiscal implications?
Thanks, Adam. So obviously we welcome scrutiny and continue to encourage an active and informed debate about our monetary policy framework and our choices. As you know, the bank used QE to reduce borrowing costs and support the economy during a succession of deflationary episodes, beginning with the GFC and then subsequent other episodes in this era of crisis that we've just been gone through. These decisions were taken by the Monetary Policy Committee with its monetary policy objectives solely in mind. So I'm not an MPC member, so I'm not best placed to answer questions on monetary policy and, the pace of QT. I mean, I put illustrations in my charts based on the past behavior of MPC, but I don't have any further insights. However, it is my job and the job of my teams to implement the decisions of the Monetary Policy Committee. This includes ensuring interest rate control, which the Monetary Policy Committee has made very clear since it announced that it will start QT, is the active tool for conducting monetary policy. A bit of this speech was about kind of how a demand-driven framework can maintain interest rate control if we have the right facilities in place, while ensuring that the balance sheet is not that large and you move from abundant reserves to demand-driven reserves. But what monetary policy decisions do mean is an unwinding of crisis-era abundance. So that's kind of what my job is, that I have to make sure that we are ready, the bank is ready, and you are ready, the market is ready for us to be able to generate these reserves, to move from years and years of abandoned reserves. There could well be participants in the market that don't remember the pre-crisis operating framework to this new framework. And that's my job today. And that means being ready to borrow from us on using all our facilities freely.
That really leads me to my second question is, when you think of implementing this new framework, and as you pointed out, you are already in transition at this point, but not fully transitioned to the, let's say, the desired state, what worries you the most, or what concerns you the most in terms of the success of this transition, which is essentially your job mandated by the MPC's decisions?
Yeah. So what worries me the most is that we may not be ready for it, which is the reason that I'm making the speech, to call for readiness, to let everyone know that we do not consider our long-term repo facilities, such as the ILTR, to be used only for liquidity insurance purposes. They're there to be used in normal times, and banks and SMF participants need to be signed up and do the tests and be operationally ready by drawing from these facilities ahead of the point at which effectively we will move to a demand-driven system from an abandoned system, and thereafter. If we are ready, I'm more worried. If we are not ready, then I'll get worried. So apart from this speech, as I have said, we're going to be talking to firms. We're going to be publishing a paper asking you questions around the calibration of our facilities, and including the ILTR, and because we wanted to make it attractive to be used. But, the balancing factors yet there in terms of attractiveness. So we're going to be asking you questions on that. And we're going to continue our roadshow. But I hope I have shown you that this point may be coming even as soon as next year. So we all need to be ready. Thanks.
Thank you. Any questions? Okay, I can see. First one was backward, and then we go second and third.
Thank you.
Can
Vicky,
I ask you to introduce yourself?
Of course. Jack Meenan at Barclays. Thanks, Vicky, for a really interesting speech. Just two quick related questions, if I can. So accepting it was a stylized chart, the final one you showed had a kind of an ultimate ratio of maybe like 90-10 to kind of repo lending based back into outright holdings. I just wondered, even stylized, is that kind of a ballpark that seemed relatively plausible? And then assuming that the repo isn't 100%, I wondered how much thinking you'd done about a position where the MPC independently wants to take the gilt holdings on the APF below whatever that threshold of outright gilt holdings that the bank wants on its own balance sheet, and how that would be choreographed across the MPC versus the bank's own balance sheet.
Thank you for these questions. So this was a stylized chart, but just to be clear, and we don't, to some degree, we are indifferent to how exactly the composition will happen. It's just that it seems to us that it's operationally much more sensible for more of the reserves to be generated by mixed repo facilities. From a financial stability, I mean, we are kind of indifferent in the sense that, you know, we just need to make sure that the system as a whole gets the reserves it needs, and that the banks are ready and operationally ready to draw from them. But I should say that from a financial stability perspective, it also makes sense. Mixed repo, which the ILTR is and the SDR is not, has the advantage that, you know, you can, of this liquidity upgrade, you can borrow against illiquid collateral. And that means that there's more highly liquid assets thrown into the system, which is good in some sense from financial stability, which is the reason we are also keen for banks to use the ILTR. I mean, this 10 to 90 is not particularly, you know, it's an illustration. As I said, our judgment is that it will make operational sense to use the ILTR to supply quite a lot of the stock of reserves going forward. And I wanted to emphasize that it should be used as a normal facility. On your second question, I mean, I would refer to you to Andrew Bailey's speech, where, but also it's mentioned in this somewhat different context in mine, that at the point that we reach the settled level of reserves, then, you know, we are no longer in a situation where we need to draw reserves down to a level to get headroom for future rounds of QE. We have reached a sort of a normal level of reserves, and then at that stage, the issue becomes, what is the composition of the balance sheet? Now, we expect that this stage will come before we have obviously unwound all of the gilts, as you correctly inferred from the graphs. Now, what Andrew said in his speech is that at that stage, the issue becomes more a financial stability issue rather than a, strictly speaking, in his view, monetary issue, because you have reached that steady state level of reserves. What I said in my speech was entirely consistent with this, but I also said that, you know, there is uncertainty about when we reach that steady state of or a level of reserves. And as we transition, as we sort of unwind QT and repay the TFSME, you know, we might find periods where reserves settle down to a level, but that's not the PMRR yet. The PMRR is kind of unobservable a bit. It's a little bit like the output gap or R star or something. So it's difficult to estimate and know where it's going to be exactly. We've got these estimates that I have shown you, but where exactly it's going to be, and whether we're going to get to it linearly or we're going to see periods where it settles at one level and then goes, is an issue that is an interesting one, and we will have to monitor and continue to analyze.
Thank you, David Robinson, Market News. If, as you say, we could reach the upper end of the PMRR relatively soon, but your ILTR is a work in progress, doesn't that become an operational constraint for the MPC when it wants to think about the pace of QT in September? And additionally, are you assuming that full reserve remuneration stays in place?
So the answer is I don't think that it becomes a constraint of the MPC because we have the SDR, and as I said, this is being the usage of the SDR has increased, which is very welcome, and it is as intended. And over the next period, so that has been increasing. And it has been associated with periods of when repo rates have increased for various reasons. And it's been designed precisely because of that, to meet fluctuations in demand in order to maintain interest rate control. So I'm not concerned, particularly over kind of the near term. But it would be good for interest rate control reasons, including over near term, over the period that you described, the next QT period, which starts in September. But it is important to use the time that we have now to ensure that the ILTR is ready to be used to supply the rest of the reserves. And that will facilitate, the generation of reserves. So banks will have different business models as well, because it's a mixed repo facility. So we've got some time, but we need to start getting ready now.
Moin Islam. I'm a rate strategist at Barclays. I work with Jack.
Can you speak up a little bit? I don't know how sensitive the mic is.
Sorry, is that better? Okay. Sorry, I work with Jack on the economic on the rate strategy side at Barclays. I have a question about what do you envisage happening to Sonia in this world? Because you've outlined or illustrated a world where repo activity will be somewhere in the region of 350 to 500 billion, but we see Sonia volumes at basically a tenth of that, at around 50 billion. So within that world, do you envisage Sonia becoming more volatile? In which case, do you envisage the bank moving away from the current floor system of interest rate remuneration back to the old corridor with marginal lending and deposit facilities, i.e. a return to period reserve averaging?
Yeah. So on Sonia, I mean, you're quite right that the volumes we have seen on both actually the SDR, which has increased, and it's now almost close to 30 billion, and Sonia are not sort of a small part of total. I mean, on Sonia, I think it's completely normal to expect that it will edge up as reserves go down to come closer to bank rate. I mean, it's been printing at 5.2 for quite some time. You would expect it to come closer to bank rate, which at the moment is 5.25. Not least because you would expect sort of banks starting to compete for deposits in wholesale markets, because there will be less abundance of reserves. On your other question of what is the operating framework, the demand-driven system that we want to operate is still it's still a floor system. The facilities fluctuate in order to be able to put pressure. There will be upward pressure because the reserves are going to be fewer than we have known on repo rates. But then we have these facilities that are going to be used, and that will place downward pressure and back down to the floor.
Any other questions in the room? Yeah, there's one more, and then we've got two online.
Thank you, Agnes Stangerita from Bank of America, UK rate strategist. So I share concerns of probably everyone in this room that we don't know where the PMRR is and that we might approach it sooner than perhaps your chart shows on the screen, because you assumed, for example, TFSME maturities as they occur, but we know that there are prepayments. Now, my question is, you are reviewing ILTR conditions. Are you thinking that perhaps STR conditions could be changed in somehow, perhaps accepting wider range of collateral as well? Or perhaps if there is scope for the banking sector regulator as well to be involved in this situation to some degree as well. And we know that UK banks are holding perhaps more HQLA than strictly required, and maybe there could be some loosening of those conditions, and that would be guidance from the regulator as well.
So, so we are looking at the ILTR. I mean, the STR, we are very happy with how it's operating, to be frank. So that's not the focus. And it's basically, it's a short-term facility. You get money as much as you want at bank rate, but against high quality collateral 1 week. It's the ILTR which has broad range of collateral that we're looking at its calibration at the moment, and that we are going to be actually discussing with the market, including through the issuance of the discussion paper this year. In terms of repayments and when we're going to be reaching the PMRR, I mean, at least these estimates of the PMRR, which has, as you quite rightly say, they're uncertain. I mean, you're even with the prepayments that banks have told us that they want to do, which I had in the chart actually. It's then you're not. I mean, you're not meeting the upper range of that estimate up before end of next year. So that's kind of that's kind of where we are. But I want to get ready. That's why we're having the conversations now and before the end of the year, just in case the situation changes. And on your question about prudential buffers, I mean, one thing that is happening, which I haven't shown here, I think it was shown a bit in my predecessor's speech last year, Andrew House's speech. There was a chart on this. As reserves are coming down, so are the deposits of the banking system. And that means, to the extent that some of these deposits are actually short-term deposits, that means that HQLA, required HQLA, will also go down. And as you have already seen, because the relative returns of reserves and non-reserves HQLA are changing, you're seeing banks already substituting towards gilts. And clearly also banks, the relative returns of short versus longer term deposits for consumers have changed because of the monetary conditions. So that does change automatically the amount of HQLA required by regulators. I mean, I'm no longer doing my previous role, but I'm still on the Basel Committee. I mean, the banks and the PRA's kind of view on big bank regulation is very much determined by the standards of the Basel Committee, and I'm not expecting a change before there is any change in Basel on that front.
Thank you. Rick, can you convey the questions from there? And then
yes, there's two questions from the audience. One is from Simon Ewell, who asked, has the Bank of England's approach been influenced by recommendations from the likes of the G30? for financial institutions to pre-position more collateral to cover a greater amount of the runnable liabilities?
I mean, we certainly were very interested and welcomed the calls for more prepositioning by the G30, but at the risk of sounding, well, I didn't do it because I wasn't doing this role, so I can say it. But we had even started, the requests for prepositioning before the G30 report is something that we think is necessary, because that allows us to value the collateral, haircut it, and make available lending in times of stress much sooner. Now, I think what the G30 report recognizes on this is at a global level is that, runs can become faster and broader than they were before. And that means even a greater need for prepositioning. And that's why that's one of the reasons I showed you this chart, that there's still quite a lot of level C collateral out there, sterling level C collateral out there, and other collateral not prepositioned. Now, I didn't show to you in the context of the G30 report so much. I showed you in the context that if we're going to generate the reserves using a majority repo lend framework. It's quite important that assets are pre-positioned to try to generate the reserves both in normal times and in times of stress. But the two things come together, are consistent.
Okay. Great, thank you. Other than a question from one participant about could they get the slides in the recording, which I assume the answer is yes. We'll circulate all those. Last question is from an anonymous attendee. As we are still in abundant reserve state, for what purpose other than arbitrage are firms currently increasing usage of the STR facility if there's no liquidity need? And at what point would that concern you and the bank? Also, at what level of spread between clearing repo rates and base rate would it concern you? Thank you.
Thanks. So, I mean, arbitrage is a good thing. In this sense, because as I have said, I mean, reserves are being drained. They're still abundant. This is what all our market intelligence and our own analysis suggest, but they're less than what they are before. And you're beginning to see these temporary factors so far putting upward pressure. And arbitrage is the mechanism through which you're ensuring interest rate control when the motive for reserves demand is relative returns, and it's not precautionary and payments driven. But at some point we will get there. So to putting it in a different way, I'm not concerned that arbitrage is happening. It is indeed the mechanism through which, in an abundant reserve system, you actually, as you move from abundant to ample, you make sure, and there are these kind of temporary shocks. You make sure that you maintain interest rate control.
Thank you.
Thank you. Last chance for a last question. If not, here. Can you wait for the mic so that people can hear it who are online as well?
Hello, thank you for your speech. I'm Rapolis, intern at Eisler. So I want to follow up on STR usage. So in his speech in May, Governor said that the uptick is temporary. Now you're again repeating that it's temporary, but gave more insights into it. But then since May, during those 2 months, it has doubled. Meanwhile, in your last chart, we don't see it going up at that pace going forward. So I wanted to ask about your thoughts into this.
Yeah, I mean, sorry, I want to distinguish between temporary factors such as end-of-month effects, large maturities that push repo rates above bank rate, which so far have been temporary, and the usage of STR, which, as you say, has been growing. And this is, as I said, is welcome in terms of transition. I mean, the reason when we speak to markets that you have seen it continuing to grow is for the reasons I've said. First of all, banks find it easier and cost effective once they have drawn on it to roll over. Secondly, they consider it normal part of liquidity management now, which they didn't used to before. This is drawing more participants in actually doing it, and they're also using it for diversity and of funding purposes, keeping relative returns in mind. So that's why it hasn't fallen with rates. It's actually kind of have grown, as you said, after this initial uptick in usage in April. But the temporary factors were more about prices rather than quantities.
Thank you. I think we can draw it to a close here. I think my last obligation is to thank you again for your reach out, for engaging with the industry. We can promise that we will be in contact with you once these discussion papers are out there, the questions are posed, and in other events where you discuss this with the industry. We wish you all the best in your new role and a successful transition to this new system. And again, we were honored and pleased that you were with us today. Thank you very much again. I would like to ask the audience to join me for a round of applause. And thank you.
Thank you, Adam. And thanks for having me. And thanks for AFME in engaging on this. And it'd be great if you're members, if you're not signed up, sign up. Thank you.